the downgraded sell has nothing to do with China. It is a risk. It's a risk that we highlighted, but it's not in our estimates. The reason why we have it downgraded to a sell is that we have 4 years of proprietary survey data, and our most recent survey showed that the iPhone is going to be down year over year. No big surprise. Everybody understands
usage,
that.
iPhone purchases, what are you talking about?
I'm sorry?
Purchases or usage for iPhone?
Purchases, right? So we double-clicked through this data over the past week for the 4 years of data. And what we were really surprised to see, though, was that the retention rate appears to be declining. So in 2016 and 2017, the percent of iPhone user install base that intended a defect over a 2-year period was around 5%. Now, in this most recent survey, it's now 9%. So if you annualize that to a retention rate, it's dropping from 98% to 95% over this 3-year period that we have the survey data here. So that really eats away at this, bullish. He says, oh, it's going to be down just because of extending iPhone cycles. No, it's more than that. We are actually starting to see shrinkage of that user base, at least in mature markets. That's what our data says. So that's one element here that really concerns us. And then that services thesis is completely hinged upon your user base being at least flattish, if not growing. And if we have evidence that it's declining, that really puts it at threat. And then
your price target, though, is so far below where the stock is right now. Why do you think the market views it so differently than you do right now?
Sure. So I think that the market is doing a rough sum of the parts analysis and not thinking critically about what kind of multiple should be on the product and what should be on the services portion. They look at the high growth services portion and say, Apple has high growth services. It only grew 18% year over year in the last fiscal year. It is slowing and is attached to the iPhone user base. So should you be putting 30x, 40x multiples on there? Probably not. You should be going out to when you have the mature services revenue, which will probably be in 2 to 3 years. That's when we'll anniversary Apple TV Plus, music, etc.
We told people we were going to tell you what worked. We're almost out of time, so I should ask you a few of your thoughts on what is working right now.
Sure. So pivoting to the U.S.-China trade war, we don't think this is going to come to an end anytime soon. And one of the key things here is protection of American intellectual property. And the inability to enforce that means that cybersecurity stocks will continue to have critical importance. So 2 names in the cybersecurity space that are best of breed that we really like a lot are Palo Alto Networks and Splunk. Both of those names have been working, and we expect them to continue to work extremely well.
The concern I have with cybersecurity stocks is today's hot cybersecurity company is tomorrow's afterthought because that sector and the technology is moving so rapidly. Do you have any of those obsolescence concerns with either one of those picks?
So Palo Alto Networks probably has the greatest breadth and the greatest mind share. There are a lot of new cybersecurity companies that do come and go. That's true, but Palo Alto Networks has undoubtedly stood the test of time. They have a strong brand and a very strong management team, and so I don't see that being an issue. In the case of Splunk, they are the machine learning company, and they've found a niche within the cybersecurity space. It represents probably about 40% of their revenue, but it's the tip of the spear for them attacking the overall IT operations management market. So they continue to have a very strong leadership position there. So both of these companies have been leaders for an extended period of time.